from you. Okay, let's get into this week's episode. When my kids were small, we would do a fire drill at the beginning of every school year. The fire department would come visit the kids at school, and then the kids would come with a homework assignment that was essentially, we had to map out how we were going to get out of the house if there was a fire, and then where we were all going to meet once we were outside the house. And so we would practice it. We'd get down on our knees and stay low and get down the steps, and then where we were going to meet outside. And then there were also some instructions for the parents, for us to make sure that like all the batteries and the smoke detectors had been recently replaced and were in good working order. I'd like you to think of today's show as a fire drill. I want you to be prepared for the coming market crash. Making plans in the good times will help you be ready for the bad times. And I like this quote from Simon Sinek. Panic causes tunnel vision. Calm acceptance of danger allows us to more easily assess the situation and see the options. Now, as I was thinking about this, roses are beautiful, fragrant flowers, and they also have these sharp, prickly thorns. When cutting roses, I've learned to wear sturdy leather gloves. Blackberries, which we have a bunch of up here in the Northwest, they're sweet, they're delicious. This time of year is the time to be out there picking them and harvesting them. But getting to those blackberries can be treacherous and painful if you're not careful. So when picking blackberries, I've learned not to wear shorts and instead wear a good pair of jeans. The stock market goes up and the stock market goes down. It's a powerful wealth accumulation vehicle, and like many of the good things in life, it can be painful at times. I've learned to create systems that reduce emotions from my stock investing. It should be no surprise that investing is both and not either or. We can bury our heads in the sand and pretend that there are no challenges or headwinds, or we can acknowledge that the challenges are there and we can prepare for how we're going to deal with them when they arrive. In today's show, I want to talk about all the chatter around a correction or a market crash. And also, I want you to think about how you will respond when that happens. I want you to prepare ahead of time so that you're not caught off guard. The probability of experiencing a significant market correction in the next 10 years is 100%. This is not if it's going to happen, it's when it's going to happen. The market right now is trading at all-time highs, and every day it seems like it's pushing higher. So why am I talking about the next market crash? Well, I meet with a lot of people, and they share with me their concerns. And so here's some of what I've been hearing from folks. Number one, the S&P 500 has not seen a 10% pullback in over a year. People are concerned about the pandemic unemployment assistance coming to an end. The eviction moratorium expired. People are concerned about the turmoil that's been taking place in Afghanistan. The COVID Delta variant is causing some additional economic concerns. Our president is mandating vaccines. Congress is pushing for $1 trillion infrastructure plan and now a $3.5 trillion of additional spending and higher taxes. But when it comes to the potential for stock market volatility, one of the most important things that people need to pay attention to is what the Federal Reserve Chairman Jerome Powell said in a recent speech. Here's his quote. He says, "My view is that the substantial further progress test has been met for inflation. There has also been clear progress toward maximum employment. At the FOMC's recent July meeting, I was of the view, as were most participants, that if the economy evolved broadly as anticipated, it could be appropriate to start reducing the pace of asset purchases this year." He then goes on to say, "The timing and pace of the coming reduction in asset purchases will not be intended to carry a direct signal regarding the timing of interest rate liftoff, for which we have articulated a different and substantially more stringent test." I recently read an article that said the Fed's balance sheet expansion is responsible for 50% of equity returns since 2010. Remember, the Federal Reserve has been pumping massive amounts of money into the economy. They did this by slashing short-term interest rates to zero and purchasing $80 billion in Treasury securities and $40 billion in mortgage securities per month to drive down interest rates. The Federal Reserve, of course, is only part of the story when it comes to easy money and stimulus. Here is a summary of the COVID stimulus. March 6th, 2020, $8.3 billion. March 18th, 2020, $1 billion for unemployment, free lunch, mandate paid sick leave, free COVID testing. March 27th, the CARES Act, $2.3 trillion. April 24th, stimulus and relief package, $484 billion. December 21st, 2020, stimulus and relief package, $900 billion. March 11th, 2021, the American Rescue Plan, $1.9 trillion. We're now on the cusp of an infrastructure plan at $1 trillion. And recently announced there's going to be a push for a budget of $3.5 trillion called the Anti-Poverty, Healthcare, and Climate Plan. One important thing to remember is that we're spending money in America that we don't have. It's called deficit spending. And when we spend money we don't have, it adds to our debt. It's kind of like saying, we don't have the money to go on vacation, so we'll put it on a credit card and figure out how to pay for it in the future. These crazy low interest rates have encouraged borrowing and has contributed to the significant rise in real estate prices across the country. Low interest rates allow for people to pay more for a house while enjoying low monthly payments. With interest rates so low for deposits at banks, more people have taken their low-risk money that used to be in things like certificates of deposit and money market accounts and shifted that over into equity markets, which has helped fuel record prices in stocks and real estate, not to mention speculation in things like crypto and meme stocks. In 2013, when Federal Reserve Chairman Ben Bernanke started talking about pulling back on asset purchases, we saw yields on Treasury bonds rise, stock market volatility jumped, emerging markets and junk bonds took a hit. We have massive amounts of debt, currently over $28 trillion, compared to about $20 trillion just in 2016. So stocks are expensive. Robert Shiller has the Shiller CAPE ratio, which is price divided by earnings with adjustments made for business cycles and inflation, and it's currently at 39.14. There's only been one time in history where the CAPE ratio has been higher than it was, and that was December of 1999, where it reached 44.19. Typically, when people are worried about stocks, they'll rebalance to hold more bonds. Many of you understand that when interest rates rise, the value of the bonds you own decrease in value if you were to sell them before maturity. There's an inverse relationship between bonds and interest rates. Rising interest rates are bad for bond holders. 10-year Treasury bonds are currently paying less than, last time I looked, about 1.3%. So now that I've set the stage for some of the concerns that I'm hearing from people just like you, let's look at some of the data around market corrections and bear markets. A correction would be when the market drops 10 to 19%. A bear market is a 20% or more. Since 1970, there have been about 28 market downturns of more than a 10% decline. Since 1970, there have been about 7 bear markets. A bear market is a decline of 20% or more from the previous high close. 3 of the worst bear markets have occurred in the last 20 years. 2000 to 2002, a 49.1% decline, and it lasted 929 days. 2007 to 2009, a 56.8% decline, and it lasted 517 days. And then, of course, the COVID sell-off 2020, 33.9%, and it lasted for 33 days. There's a great chart that was published by First Trust, and I'll include it in the link to the show notes, but it's called Bull and Bear Markets since 1920. It was from 1926 through 2017. And in this chart, they show that the average bull market lasts 8.9 years, and the average bear market lasted 1.4 years, with an average cumulative loss of 41%. Remember, corrections and bear markets are part of the investment landscape. Investing is both petals and thorns. Investing is both booms and busts. They're normal. The market volatility is easier to cope with when we're working and contributing to our retirement accounts, because as long as we have income, we don't really have to worry about stock market volatility. The problem with the investment volatility is that it causes people to try to time the market. It causes people to think they know when to get out and when to get back in. When you're working, it's easier to handle the volatility because losses are just on paper. You're not having to pull money out of those accounts, and hopefully you're continuing to contribute to your investment